Emily Chang, and this is the best of Bloomberg Technology, where we bring you all our top interviews from this week in tech. Coming up in the next hour, Beijing called President Trump's decision to slap tariffs on another $200 billion worth of goods, quote, totally unacceptable, but stopped short of spelling out what it will do in return. We discuss the tech fallout in the ongoing trade standoff. Plus, a downbeat debut. Xiaomi shares drop on its first day, though recover some ground as escalating trade tensions and uncertainty about its valuation leave investors feeling skeptical. And our exclusive conversation with Pandora CEO Roger Lynch. We talk about its recent partnership with Snap and how the streaming service is fighting off the likes of Spotify and Apple. But first, to our top story, another day, another new escalation in the ongoing U.S.-China trade dispute. This time, the White House is threatening to impose new 10% tariffs on $200 billion worth of Chinese-made products. The list this time includes tech goods like televisions and electric car batteries. One big-ticket item missing this round, the smartphones made by U.S. companies like Apple that are assembled at plants in China. So while your future iPhone may be spared, for now, consumer tech might soon see some price hikes. We spoke with Bloomberg Tech's Mark Gurman on Wednesday, who covers both Apple and consumer technology.
First thing we have to note is right now it doesn't appear that Apple products like the iPhone and the iPad and the Apple Watch are affected.
Why?
There's a lot of different reasons why, but one of the biggest points of emphasis is that Apple is a California company. They are based in the United States. Donald Trump and Tim Cook, the CEO of Apple, they have talked about this many times. Cook has said that he doesn't think that these tariffs are the solution to either the problem that the U.S. administration is saying is out there. And there's other facets to it. The products are designed in the U.S., even though they're manufactured in China, and then Apple sells them all over the world. So it's unclear what kind of hit they would get on these tariffs, but there's a lot at stake here.
What about the components that go into iPhones and iPads?
Right, and so if you look at the components that are on the list of tariffs, it's not a big amount of components that are in the iPhone. The iPhones now are increasingly made of stainless steel, different types of metals. What we're seeing is some steels and some aluminums on the tariffs. It's unclear what percentage of the phones are actually impacted, and if there's actually going to need to be a price hike on the iPhone because of the margins Apple already gets. Could they switch to other components if necessary? Would they do this just for phones sold in the US and China? Different things here, but if you look at Tesla stock is down today because cobalt battery technology is actually on today's list of $200 billion of new stuff, and that is the core of the batteries that power electric vehicles.
I do have a chart in my GTV library that TVs from China may be getting a lot more expensive. What's going to happen?
Yeah, that's really interesting. The problem is why I don't think it's a big deal is because there's very few very high-end China-based TV manufacturers that sell their TVs in the United States. Many of the TVs sold in the United States are made by Sony and Samsung. Those are companies that are not necessarily affected by the tariffs.
So what is the actual impact then going to be on consumers here? What should we be worrying about?
What should we be worrying about? Well, cobalt batteries, as we see more electric cars happening. But I think outside of the U.S., really we have to focus on the retaliatory tariffs. What is China going to do about this? And that's where Apple really can be affected. About 20% of Apple sales across 2017 were in China. If China slaps growing tariffs on the U.S. for selling iPhones in China, then that could be a problem for Apple in the region. There has to be a decision to be made. Apple can't get away with not being a company affected by U.S. tariffs and not being affected by China's tariffs. They're going to be affected from one side or the other. It's to be seen which side they're affected by, if either.
So, we saw Tesla now working towards opening a plant in China. This has been going on for a while, but it certainly goes against Trump's direction here. But what are some other solutions for these companies?
Yeah, more solutions are to have a homegrown manufacturing of different components, building cobalt in the United States. If you look at Apple, building devices in the United States, bringing up metals and other technologies in the United States. But that also has effect on consumers too, because as we know, products built and developed in the United States, anything with a made in the USA slapped on it, are traditionally more expensive because the labor costs of building products in the U.S. are still far higher than they are in China.
All right, Mark Gurman, Bloomberg Tech, as always, thanks for keeping us posted. Meantime, President Trump has embarked on a European tour with a sequence of high-profile events, starting with a NATO summit in Brussels. Let's get to Bloomberg's Caroline Hyde in London with more. And Caroline, it was quite A dramatic and remarkable day. Walk us through the day's events.
I mean, just extraordinary. And in some ways, tech was involved because a lot of these arguments seem to come out via Twitter, of course, Trump's favorite mode of communication. And he took to Twitter ahead of the NATO as he was arriving in Brussels, really hitting out at the defense spending of the EU, saying it wasn't high enough. He was complaining about the trade deficits that he has with the EU, the so-called tariffs and barriers to entry he complained about. He had such a Twitter tirade that it sparked the other key Donald that we have here in Europe, the EU president. He's president of the European Council, saying, that's Donald Tusk. He hit back saying the US doesn't have and won't have a better ally than the EU. He then had the Secretary of State for the US, Mike Pompeo, saying what a wonderful institution NATO was, all on Twitter. I mean, it's extraordinary. Then even had the old Secretary of State, of course, John Kelly, saying he has never seen anything so strange or counterproductive than what has been going on in terms of the President Trump's reaction at NATO, notably really hitting out aggressively at Angela Merkel's Germany, saying that Germany is too reliant on Russian energy, on Russian gas. So, I mean, just unprecedented NATO meeting.
So was there any agreement between these seemingly fraying allies?
You have to ask the question, and even while we see Donald Trump calling for greater spending, he wants the other allies, the other nations to double their commitment to defense spending. That's his real gripe. But there does seem to be something that they are working towards, and it's actually involving tech. It's cybersecurity. We did get a key announcement, press conference coming from the Jens Stoltenberg, he's the NATO General Secretary, saying, yes, we have agreed to up our investment in so-called, what they call hybrid warfare, so ensuring that they're protected against cyber attacks that are then interweaved with armies on the ground. They've got a new cyber operations centre to be announced. It's going to be drawing on members' cyber capabilities. So there was some agreement there, but notably an awful lot of tension.
Bloomberg's Caroline Hyde there in London. Well, UK regulators may fine Facebook $664,000 over the Cambridge Analytica scandal. The social network failed to prevent user data from falling into the hands of the political consulting firm that worked on the Trump campaign. Regulators say that data belonging to as many as 87 million Facebook users and their friends may have been, as we've discussed, misused. Coming up, Xiaomi's IPO calls the company a new species, different from any other tech company on the globe. But are investors buying it? And later this hour, President Trump's Supreme Court nominee is making the rounds on Capitol Hill. What tech cases might come before him, we'll discuss. This is Bloomberg.
This is news, but not as you know it. This is TikTok by Bloomberg, the first and only global news network built for Twitter. Objective reporting that you can trust. Curated comments that provide insight. TikTok by Bloomberg, 24/7 news streaming live on Twitter.
In San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day winning streak.
Moves in the currency market, averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the first word Asia.
U.S. and Japan duke it out over exchange.
China's slumping onshore bond market is great.
It was Hong Kong's biggest coming out party in 2 years as Xiaomi made its public debut this week. Xiaomi's market value is now in the region of $50 billion, making it the world's third biggest publicly traded smartphone maker. Bloomberg's chief North Asia correspondent Stephen Engel has more from Hong Kong.
Xiaomi shares fell right out of the gates here on its IPO in the Hong Kong Stock Exchange. A lot of uncertainty about this company and its lofty valuation that put it more than Apple, more than Facebook, more than Tencent. Also, the true nature of its business. Is it more of a low-margin handset manufacturer, or is it, like the chairman, Lei Jun, says, a broader internet services company? Oh, and also, there's a backdrop of a growing trade war between China and the United States that has dampened sentiment here in Hong Kong. The company says it's a tough one to pigeonhole.
We are actually a new species. We are an internet company that can do e-commerce and hardware well at the same time. I don't think there's anything like us in the market before.
On the one hand, Xiaomi is now a $50 billion company, the third largest in the world for handset manufacturers. But it's a far cry of an earlier estimate last year of a valuation upwards of $100 billion. The size of the IPO also really scaled back down to about $3.1 billion US from an initial estimate or aim of about $10 billion. One dampening prospect was the elimination of a corresponding listing in China, in Shanghai, of a CDR. That's a China Depository Receipt. Even the regulator in China shared similar concerns as investors here in Hong Kong about its lofty valuation and the true nature of its business. Stephen Engel, Bloomberg News, Hong Kong.
And we dove into the debut from every angle Monday with Ben Harburg, managing partner at MSA Capital, a Beijing-based venture fund, along with Bloomberg Tech's Mark Gurman and Shelley Banjo.
They have a lot to prove right now. They are very localized to China and some of the more developing markets like India. They are doing very well in both India and in China, but that's just one portion of the world. There's obviously the whole trade war tension right now, and the ability for Chinese hardware makers to get their devices in the U.S. and Europe is becoming an increasingly difficult problem.
Shelley Banjo also joining us now from New York, our tech reporter who's normally based in Hong Kong. Shelley, how much of a disappointment is this?
I think it's a big disappointment just because of how much expectations were built up. I think if Xiaomi would have come to the market and as they were, it was a big accomplishment for what they've been able to do. 8 years in existence and becoming, one of the world's biggest smartphone companies. But they didn't just rest at that. Instead of saying, this is who we are and this is what we make, they said, we're actually this $100 billion company that, is an internet services business. And so that's kind of where this mismatch lies.
Ben, I just want to point out, Lei Jun, the founder of Xiaomi, is an investor in your fund. Would you be a buyer of Xiaomi today?
I am. I mean, I think it's
at twice the price of Apple.
I am. I mean, I think it's a business that's really been underestimated and misunderstood. I think it's a company that's delivered a product, hardware that is actually a delivery device for multiple services. And in order to be a $100 billion company, I think they have to really disrupt and destroy an entire business. In this case, it's IoT. What they've done is they've made it democratized, and they've put devices in the hands of everyone, not just in China, but in multiple emerging markets. And that gives them a platform then to deliver services at a very high margin.
Mark, you cover Apple. Is this worth twice as much as Apple?
Is it worth twice as much as Apple? I mean, if you look at unit sales that Apple is selling at, it's unprecedented. But if you go back to what Ben was saying in terms of delivering the services across hundreds of millions of devices across the world, that's where the lucrative markets are. We see Apple and Google and Amazon all shifting towards a services strategy. The problem is that Xiaomi, obviously a China-based company, has so much competition in the services world. We have Tencent and everyone else trying to get a piece of the pie there. WeChat, it's a whole different world in terms of services there. And Xiaomi is not ahead of the pack in terms of that.
And you heard the company make the argument earlier that they're an entirely different new species. Are they really an entirely different new species?
There's nothing really new there. No.
Ben?
I think they are. I mean, again, in the IoT space, what they're doing is you had all of these disparate makers, people like Fitbit, others. They've essentially wiped all of them out by making a product that they can sell for a tenth of the price, still at profit, but then they can integrate it into this platform. So it's really only early days in the services platform. They'll provide things like healthcare, insurance, finance, all kinds of other apps that they can plug you into once they've got you. It's really unprecedented for us as Americans, but when you buy a Xiaomi television, for instance, you're forced to watch advertisements on it. So once they're in your home, which they will be because the products are superior quality but at half the price, you have to take their services. It's a delivery device.
Shelley, how much of this result is about being caught up in a trade war?
I think that's the line you're going to hear from a lot of people, that, oh, this was kind of bad timing, and they're not wrong. I mean, this isn't great timing for the markets. If you look at China and Hong Kong in general, both markets are down, and there's a lot of jitters about the trade war. But the thing is, Xiaomi's not even in the U.S. right now, so their business isn't actually going to be affected by anything having to do with the trade war, and so Xiaomi specific probably won't be that impacted by trade war, at least in the near future.
Mark, you've done a ton of reporting on the devices coming out later this year, including new iPhones. What is the hardware lineup that Xiaomi is going to be up against from Apple and others?
Yeah, and speaking of that, I still think there's an opportunity for a player, whether they're US-based or China-based, to come in with a very high-end premium phone at a sub-$500 price point. We've seen other Chinese phone makers do that. We've seen companies like OnePlus do that. Apple, to your question, is working on a cheaper iPhone as well, but no one has really nailed it. No one has had that combination, to Ben's point, of something that's good and cheap that people are going to buy in high volume. So Xiaomi had that opportunity, and right now in this political climate with this administration, it doesn't seem plausible that Xiaomi, Huawei is having this problem as well, ZTE, is going to be able to have that success in the U.S.
Ben, given the showing here, you're an investor in several other Chinese tech companies, Meituan, for example, another company that's planning to go public soon. Do you think this could lead some of those companies to change plans?
I don't think so. Again, I think it's tough timing. I think they were the first out the gate with a dual share structure. They had the CDR hiccup at the beginning. I think it's just a difficult position for them. Meituan, obviously a very different business, one that I think global investors understand a lot more easily because it replicates a lot of existing models under one platform. You can kind of show how all those integrate. Much more understandable than this new species, as Lei Jun describes it. We would call an Indominus Rex, something that's a combination of multiple business models under one roof. Really difficult to understand.
Shelley, Xiaomi also has the mainland China half of its listing to come. How is that going to work, and could the company recover?
That's something that remains to be seen with what's going to happen with the CDR. I mean, they really tried to push for it. They want to be part of it, but there's big disconnects between what the government wants, what regulators want, and what companies want. And so it's going to take at least 6 months for Xiaomi and the regulators to work through this. Could take a year, or it could never happen. I mean, it's still this new thing that no one has really been able to figure out. And Xiaomi was supposed to be the test case, and that didn't happen. So we'll see what happens if other tech companies, maybe more established companies like Alibaba, come forward first, and that might lay the way, pave the way for a company like Xiaomi to come after that.
Ben Harburg of MSA Capital and Bloomberg's Mark Gurman and Shelley Banjo. And there is a new sign the long-struggling recorded music industry is continuing its comeback. China's Tencent plans to spin off its online music business and list shares in the United States. The move will let American investors bet on the Chinese market for music streaming. Those services have brought new life to an industry that's been plagued by piracy. For the second year in a row, consumer spending on music has seen double-digit growth. Last year, U.S. music lovers spent over $8.7 billion, up 17% from 2016. And speaking of music streaming, coming up, Pandora's new CEO Roger Lynch joins us for an exclusive conversation. That is next. This is Bloomberg. Just last month, Snap made its first big foray into working with outside developers by launching SnapKit. One company teaming up with Snap, Pandora, the largest music streaming service in the United States. Pandora listeners will be able to send songs to friends through song cards, expanding Pandora's social sharing capabilities. Recipients of the shared music can then swipe up and listen to the song through Pandora's Premium Access feature. Now, Pandora and Snap aren't the first to do this. Earlier this year, it was announced that Instagram would partner with Spotify to share music on its Story platform. We spoke with Roger Lynch, CEO of Pandora, for an exclusive interview.
Music is fundamentally a social experience, and the ability to share it on Snap now, the first time for Snap to be doing something with a music partner, I think is pretty meaningful.
So Instagram has a close relationship with Spotify. As I mentioned, Spotify has a close relationship with Facebook. Is that why you picked Snap or chose to partner with Snap?
Well, we chose Snap because they have a younger listener base who's very, younger listeners tend to be more engaged with music. And it was the big social media platform that really hadn't enabled music sharing in the way that we thought we could really do something unique with.
So talk to us about, look, Pandora has been going through a lot. lately. A lot of executive turnover, this big investment from Sirius. How have things changed since then? Because investors were hoping for a buyout.
Yeah, well, I mean, all that happened before I joined. So last year did go through a lot of turnover, which led to me joining the company in September. And it's really settled down quite a lot since then. So we closed the Sirius XM investment right at the time I was joining. And since then, we've really refocused the company on a couple things. One is, we are, as you mentioned, the largest music streaming service in the U.S. 70% of our revenues come from advertising. Digital audio advertising is the one big digital advertising business that's not controlled by Google or Facebook. Pandora is actually the largest in that. So we've been investing in that. We bought a company called AdsWiz, which is the leader in audio programmatic, which really helps us, really invest in our strength of digital audio while we continue to grow our subscription business nicely.
Now, there's been this perennial question of whether Pandora is a standalone company or an acquisition target. I mean, is it a wait and see? Is that something you're open to, or do you see Pandora going it alone?
I can certainly see why other companies would find Pandora attractive, because there are few companies that have the scale of Pandora. But our strategy is to build on our core strengths. And we are, as I mentioned, the largest in digital audio advertising, and we're investing in that and continue to grow that revenue base and with the investments that we're making, while we also grow our subscription business.
And yet you have Apple, Amazon, Spotify, Google, all chasing music with minimal profits. What is your strategy for profitability?
Yeah, again, it's, if you think about consumers, they're not homogenous. Not every consumer is going to pay a subscription. Most will consume music with an ad-supported, like they do on terrestrial radio today, which is a $16 billion marketplace, still waiting to be migrated away from traditional broadcast to IP streaming. And Pandora is really well positioned for that. So when we think about competition, of course we think about Spotify and Apple for our subscription business. But remember, 70% of our revenue is advertising. And that's more of our competition there is really more about terrestrial radio.
But what's the plan if artists start to really push buying their albums on paid streaming services?
That's great for our business. Our paid streaming services last quarter grew 63% year over year. So, it's a fast-growing part of our business. And but again, we think consumers some will choose ad-supported, some will choose subscription, and we're really well positioned because we're strong in both of them.
Do you think content costs will continue to go up?
I think that there's a moderating effect that's happening now, and we see it as the platforms start to gain more scale in streaming, and it's really to the benefit of the industry, because you're now seeing the music industry finally growing again after 15, 18 years of declines.
It's been a long time.
It's growing, and it's growing because of streaming. And so I think that there's a balance that's being found now between labels, publishers, and streaming services that understand that it needs to be a healthy ecosystem, because it is the future of the industry.
That said, listener hours were still down in the first quarter. When do you see that turning around?
I think that we have a big opportunity to grow engagement. So not just listeners, but also hours with our listeners. And that's a combination of what we do on the marketing front, what we do with our product and new features, like we've launched personalized playlists and premium access that lets any listener, whether you're ad supported or not, play any song. And those things start to move the needle for us on engagement.
So do you think you could turn them around by the end of the year?
I think that we're going to start to see improvements in that. And we'll continue, just like last quarter, we saw an improvement in, yes, it was still a decline from the prior year, but it was a big improvement over the prior quarter. And we expect to continue to be able to make improvements.
That was Roger Lynch, CEO of Pandora. Coming up next, we will hear from a London-based VC on how Brexit is affecting the investment landscape. Our conversation with Index Ventures' Mike Volpe is ahead. And Bloomberg Technology is live streaming on Twitter. You can check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Emily Chang. It's been more than 2 years since Britain voted to leave the European Union, and the divorce was all but settled. But now the road ahead is in question. Prime Minister Theresa May has proposed to keep Britain closely aligned to the European Union on trade and regulation after Brexit. And while most of May's Conservative Party seem happy with this deal, the move towards a softer Brexit led to the resignation of May's chief Brexit negotiator, David Davis, and Foreign Secretary Boris Johnson, the face of the campaign to quit the EU.
We do not agree about the best way of delivering our shared commitment to honour the result of the referendum. It is a proposal that will take back control of our borders, our money and our laws. But do so in a way that protects jobs, allows us to strike new trade deals through an independent trade policy, and keeps our people safe and our union together.
With May's own future, the future of the UK's trade relationship, and a possible second referendum in the balance, what does it mean for Britain's vibrant tech industry? We spoke with Bloomberg's Caroline Hyde.
They're concerned about the proposal. At the moment, they're really concerned about the fact that it sections out services in particular. Now, about 80% of all exports coming from the tech sector in the United Kingdom are services-based. And they're saying at the moment this is a lopsided deal, because what Theresa May's proposal spells out is that you'll have some sort of free trade arrangement in terms of goods that you are seeing imported and exported between the UK and EU, but not services. And then therefore saying, look, we could see two separate regulatory environments. This is unnecessary concerns for UK-based tech businesses, yet more headaches in terms of the regulatory environment they're going to be facing. They're also laying out that, look, there's not enough visibility yet in terms of freedom of movement of people. This has always been a key battle cry for the tech sector. We are worried about talent. Yes, the UK government has been backing new ways in which you can have entrepreneurs come into the country, a new visa for entrepreneurs, but that's not enough in terms of hiring. And notably, they've got other key concerns going forward about the way in which Brexit might occur, and the regulatory environment for data as well, the way in which data is processed across the borders. So at the moment, Tech UK, which is a key voice for the tech sector, is saying we're worried.
So how likely is it that this deal, clear that Prime Minister May's party is behind her, how likely is it that this deal will be accepted in the UK and by EU lawmakers?
At the moment, not very likely, if we're to be believed already coming from Michel Barnier. Michel Barnier is the key negotiator on behalf of the EU. He's been in New York today, Emily, and already sounding off that he doesn't really like the sound and the smell of what is being proposed at the moment. Because I might add, at the moment, all we've got is 3 pieces of paper coming from the UK government. We haven't yet got the actual white paper, which is some 200 pages or so. But as it stands, the fact that the UK's sort of trying to cherry pick here, wanting to have a free trade agreement in terms of goods, but not in terms of services. They're saying, look, that's not cool. What we want is, if you want to opt in to our single market, I'm afraid you have to allow the free movement of people, of capital, and indeed of goods and services, and you can't pick and choose. So it looks as though Michel Barnier and the EU might push back quite hard, even though we've heard from businesses already, the likes of Airbus, which has a big amount of employees here in the UK. It's a French company. They've been saying, look, go easy, please, on the UK. They are trying to extend an olive branch here. But at the moment, Emily, it sounds as though this won't cut mustard when it comes to the EU, and let alone get the support that Theresa May needs in her own parliament in the United Kingdom, because remember, she doesn't have a majority in government, and therefore she'd have to get all of the Conservatives to toe the party line and perhaps look across the bench, look across the aisle to get the Labour Party to support her as well.
All right, Caroline, stay with us, because despite all of this uncertainty around Brexit, VC investments continue to hover near record highs. Through the first quarter of 2018 alone, PitchBook reports European VCs have invested $5.2 billion. That is the 4th highest quarter of the last decade and would match the last year's record pace of investment. Meantime, London-based VC Index Ventures has invested $7.25 billion to date in a portfolio that includes notable tech startups like Dropbox, Skype, iZettle, and more. And they've just raised $1.65 billion for 2 new funds targeting companies in Europe and the United States. Mike Volpe, a partner at Index Ventures, is here with me now as well. So did all of this political uncertainty around Brexit impact your fundraising plans? Did you guys talk about this?
We talk about it because it's current news and it's important, but fundamentally not that deeply. 2018 has been a good year for us. We've had 4 major multi-billion-dollar exits, and hopefully with Sonos going public in a month or so, we're going to see another one. that environment creates a lot of interest from investors that want to provide us with the capital to invest in companies. So we were able to raise the money without too much trouble, fundamentally. The one area, obviously, that we're always on the lookout for is immigration and movement of labor. That's important to us. But most of the companies we invest in are small and young, and cross-country labor and cross-country borders and tariffs and so forth aren't really their concern in the beginning. They're just trying to build a product that consumers love.
Well, and recruiting is one of the biggest issues now facing some of these companies, given all of this uncertainty. Is it impacting your strategy? Is it going to impact your strategy at all in terms of where you put this money now?
No, not that deeply. I think the competition for labor is absolutely critical. The most difficult part is typically the competition between the large and established companies, the Googles and Facebooks, versus our small companies that are trying to get that same labor. And so having more of that labor is helpful, but also it's really competitively positioning against a Google and Facebook and saying why working at a small company is more exciting.
And Caroline, based on the numbers, it certainly seems like other investors in Europe aren't holding back either. Is that what you're hearing?
Yeah, in terms of actually, London is not only a key tech hub in terms of Europe from where the companies are being born, but also where the money is. That hasn't changed since Brexit. You see Index Ventures, of course, as a key hub here in London, but an awful lot of the VCs are based here that are looking to get active in Europe, and they're raising more and more funds. Not only are we hearing this whopping amount of money coming from Index Ventures, but we're also heard from Highland in Europe. They're based in a key hub in London. They've been raising money. 8 Road Ventures been raising money, Octopus Ventures, Dawn Capital. We've got record amounts being raised, and we've also got record amounts being invested, because despite all the Brexit uncertainty, last year we saw a record amount of money come in to UK tech firms. So it's thus far, you can't run a counterexample. I can't tell you what it might have been if Brexit hadn't occurred. Would it have been more? But as it stands, London is still the #1 tech hub in the whole of Europe.
So, Mike, you got some competition there. In Europe, in particular, what are you bullish on?
Look, there's a number of sectors that we really like. One of the areas where the UK has helped us a lot is we are very early in fintech, partly because of the regulatory regime in the UK and a lot of entrepreneurialism around fintech. We started early in that sector. We had Adyen in our portfolio.
Adyen just went public,
exactly.
Right? Big exit for you.
We have a company even in the US called Robinhood. The UK really helped us in that context. So we continue to invest in that area. We do like commerce and retail. We've done companies like Farfetch or Etsy. Farfetch is also largely based in London, so we're seeing commerce thrive in that environment. Another area that we like a lot is sort of urban mobility and transport. Deliveroo, which is also based in the UK, it's sort of like for American audiences is like a DoorDash, but it's actually quite a bit bigger than DoorDash all across Europe. They were based in the UK. At the same time, we're investing in urban mobility like e-scooters, famous Bird. We're investors there. We did that one quite early. Aurora, self-driving cars. Those sectors we still invest in deeply, and then some of the kind of enabling technologies, enterprise software, AI, those are the key sectors we continue to look at.
Lots to unpack there. Let's start with e-commerce. Amazon's ambitions seem to have no bounds. You know, given that you're invested in some of these other e-commerce companies, how concerned are you that Amazon is just going to destroy the competition?
Well, Amazon...
They've got Handmade.
Absolutely. I think Amazon is a formidable force. And I think there is some talk in VC circles about how it's impossible to do anything in the vicinity of Amazon. But what we found is that there are segments which are quite large, particularly, for example, in high-end fashion. A couple of recent investments. We talked about Farfetch, which serves the very high end of the market.
And Amazon's also getting into fashion, though not the high end.
Although if you think about it, the brand of Amazon, at least today, doesn't necessarily carry over to the high end of the market. If you look, most of the brands that you would think about, Yves Saint Laurent, Gucci, et cetera, they don't necessarily want to be listed on Amazon as a product. So I think there's an opportunity there. We invest in a company called Goat that makes high-end sneakers or provides high-end sneakers. Again, not something that you would find on Amazon. So there are sectors which are quite large, and you can still build good companies around it. So I think it is important to recognize that they're a force, but it is not impossible to invest and to make good investments around them.
Thanks to Mike Volpe of Index Venture and Bloomberg's Caroline Hyde. Coming up, charging up for an electric scooter, Turf War. We'll speak to the Lime CEO and co-founder Toby Sun next. Plus, Tesla sets its sights on China, signing a deal in Shanghai to build a factory that can churn out 500,000 vehicles a year. How big a blow is it to President Trump's trade campaign against China? This is Bloomberg. Grab Grab is opening its app to external developers and startups. The Singapore-based car-hailing giant is attempting to transform into an everyday super app that encompasses everything from maps to payments to food delivery. Think WeChat. CEO Anthony Tan said the new services could push revenue beyond $1 billion this year for the first time. Electric scooter rental startup Lime has announced a $335 million funding round, which includes a partnership with none other than Uber. Details of the alliance are still to be finalized, but Uber says it will promote Lime in its mobile app. The financing, led by Alphabet's venture arm GV, pushes Lime's valuation to $1.1 billion. But will it give the company an edge in the brewing two-wheel turf war? Joining us to discuss the deal, Lime CEO and co-founder Toby Sun.
Uber will be our strategic partner, right? So they will start from investing, and then on top of that, we'll be also doing co-branding, and also we'll make our scooters available on their app.
So are we going to see the Uber sign on Lime
Yeah,
scooters?
we're still figuring out the details, but possible. Yep.
So how much business will this actually drive for you? New business?
Yeah, it's a good question. We still don't know, but so that's the purpose of this partnership, right? So this is a new space. We want to figure things out, and thrilled to have Uber as our partner, and then we'll test it out and then see how it works.
A $1.1 billion valuation is significant. What are the numbers to back that up?
So this is a massive market, right? Transportation, mobility, and first and last mile transportation has been a challenge for a lot of the high density cities, right? So we have seen a lot of people, started to use that for fun, but now a lot of people are using that for commute, to embed that into their daily life. And if you look at 2013, when Uber first raised their 3.5 billion round, right? So people feel that's a little bit surprised.
Also from GV.
Yeah, also from GV. And then now if you look at Uber, it's already over 60 billion, right? So I think the most important thing is we're creating a movement that changes people's behavior. If you think of that way, I think this is not a crazy evaluation.
How many rides a day?
So we can't disclose that, but I would say we're growing really, really fast, and then we're serving we've already done over 6 million trips so far in only 12 months.
Now, it's been said that this business could be more profitable than a ride-sharing business because you don't have to pay drivers. Is that a fair assessment? It's hard to believe that you could make more monies renting bikes and scooters than Uber can make sharing cars.
Well, we don't know about the Uber's economics, but apparently, taking, not paying the drivers and cars is a big, cost reduction for us, right? But I think more importantly, we're solving a higher frequency use case, which is, shorter distance. That's part of most of the transportation needs on the everyday basis. So I think that's a big, foundation of our potential, market.
Now, there are challenges in every city, and every city is unique. Yep. And in San Francisco, there's a freeze on scooters right now. People were not happy with the scooters getting left around, and now they're going to be doing a trial program where they're going to pick 5 companies that can have it out. And you're applying for that right now. Yep. What's going to make it different this time around? Like, what can you promise the city and the residents who got pretty annoyed?
So we hear the feedback, and then we actually one thing that differentiates us from the other players is that we take city relationship very seriously. Before we launch, before going to any markets, we talk to the city officials. Sometimes MTA or Department of Transportation, and we hear the feedback from operating about 10 to 12 weeks in the past, and we're implementing a lot of exciting features. For example, after each ride, we ask the riders to take a picture about their parking so that people are held more accountable to that. Also, we're hiring locally so that we have a operation team on the ground, making sure things are all in orderly manner.
So you're taking the non-Uber approach to working with cities.
I would say we learn from all of the best practices, no matter it's good or bad, right? So we want to make sure that we do the best for the city.
Thanks to Lime CEO and co-founder Toby Sun. Well, Tesla is expanding its footprint in China. Tesla will become the first foreign automaker to open a wholly owned factory in China and forego a joint venture arrangement. Bloomberg's learned that the electric car maker is planning to build a factory that could produce 500,000 vehicles a year. The plan deals a huge blow to President Trump's trade campaign against China. Tesla follows Harley-Davidson in charting plans to expand outside the United States to circumvent tariffs under Trump's escalating trade dispute. We spoke with Tigris Financial Partners Chief Investment Officer Ivan Feinseth and Bloomberg Businessweek's Max Chafkin, who covers Tesla for us.
The difference between this and the Harley-Davidson situation was that, Harley was manufacturing in the U.S. and then made an announcement saying, we're going to move some manufacturing in Europe because of this trade war. On the other hand, this is something that Tesla has telegraphed. Musk brought it up last year in November. It's something that's been out there. This has been part of their plan. So I think it's a little different. That said, we are in, politically dangerous waters once you start talking about basically U.S.-China trade, especially right now.
Now, Ivan, Tesla was hit by retaliatory tariffs in China. This would avoid that. How big is the market for Tesla in China?
Well, China is very heavily focused on electric vehicles. They want to be all electric by 2030. So it is also China is going to, at some point, surpass the U.S. as the world's largest car market.
What do we know, Max, about the plant in China? What will they be making there? How soon? How fast?
We don't really know much. It's what happened today is Tesla signed a memorandum of understanding. This is like basically the first step to opening this plant. The assumption is that this will be used to make Tesla's lower end sort of mass market cars. That would be the Model 3 and a car that people are calling the Model Y, which is the sort of like SUV version of the Model 3. So we're talking about cars that are selling in the U.S., starting around $35,000. Most people, fully loaded or whatever, you're talking about more like $50,000. So that's the sort of assumption going in. But the truth is, we don't exactly know how this is all going to shake out.
Now, Ivan, I know you spent some time in China, and obviously many Chinese drive U.S. branded cars, though they are also made in China. So it's not, quite, as dramatic a step. GM, for example, builds a lot of cars in China. How does this compare to the footprint of other U.S. automakers there?
Well, actually, I saw more Buicks in China than I see in America. But China will become the world's largest market. They are focusing on electric vehicles, and this is going to be a tremendous opportunity for Tesla. And you want to build locally because of the cost of shipping. The more expensive and the bigger an item is, you want to build it as close to the local market as you can. And of course, if you do build locally, you avoid tariffs. And I don't really think this is an issue with President Trump's war on China with tariffs. I think it's addressing a local market opportunity.
That was Ivan Feinseth of Tigris Financial Partners and Bloomberg Businessweek's Max Chafkin. Still ahead, the Supreme Court's tech docket. We know the nominee, but what tech-affected cases might he weigh in on if confirmed? We'll discuss. This is Bloomberg. The pick is in. President Trump has nominated conservative U.S. Court of Appeals Judge Brett Kavanaugh to replace outgoing Justice Anthony Kennedy. Kavanaugh's appointment has provoked strong partisan reaction. Take a listen to Senate Minority Leader Chuck Schumer.
In selecting Judge Kavanaugh, President Trump did exactly what he said he would do on the campaign trail: nominate someone who will overturn women's reproductive rights and strike down health care protections for millions of Americans.
Meantime, Senate Majority Leader Mitch McConnell praised the president's choice. Take a listen.
Judge Kavanaugh understands that in the United States of America, judges are not unelected super legislators whom we select for their personal views or policy preferences.
Now, whether or not Kavanaugh is confirmed by the Senate, the Supreme Court's next session will have some important tech-centric cases to hear. Bloomberg Tech's Garrett DeVink joined us to discuss.
So probably the most sort of consequential case that Kavanaugh has had a say in terms of what's in front of tech today would be about net neutrality. And he didn't make a ruling that sort of went into law. He actually dissented on, a judgment made by some of the other judges on his court. And he actually, was in favor of pushing back net neutrality. Of course, we know now that, Congress has gone and legislated away those rules that were put in by Barack Obama earlier. But he was in favor of getting rid of net neutrality, and his argument actually focused on free speech. So he said that internet service providers should have the First Amendment right, the free speech right to decide what goes over their wires and how fast it goes. And so that was sort of his take on net neutrality, which of course is very important for big tech companies and for people who follow tech today.
And there are some, upcoming tech-related cases that the Supreme Court could likely hear in the near term. So if he is confirmed, what does that mean for the future of the Supreme Court?
I mean, he's pretty young for Supreme Court judges. He's 53 years old. If, in all likelihood, he will serve on the court for potentially decades to come. You can only imagine what kind of tech questions will face him. Maybe we'll even get a ruling from him about whether AIs should be treated and given the same rights as humans. Who knows? I mean, if we're looking forward 20, 30 years, you can only imagine the kind of tech-focused questions that will come before the court. Much more sort of, in front of us now. There's a case about Apple and whether it has the right to sort of charge the commissions that it does on its App Store while making developers only develop for its App Store. So that's an antitrust question, and which is, of course, is a very pressing and major question for the major tech companies. Things like such as, is Amazon becoming too powerful? Is Apple too powerful? Is Facebook, should it be regulated like a public forum rather than a private company that can decide what goes on within its own networks? But he does tend to favor, governments kind of taking a step back. He's been relatively conservative when it comes to cases about IP and copyright. Some more progressive activists might want to sort of push back some of the strict copyright rules that we've seen in the music and recording and television industries. He ruled in favor of sort of a more conservative interpretation of those things. So, at the end of the day, probably the safest thing to say about Judge Kavanaugh is he's skeptical about the government getting too involved, but he's also conservative about, these sort of business cases.
Now, walk us through the timeline. I mean, the Democrats are already fighting back, and the Republicans have zero room for error here, especially in McCain's absence. And there are already some Republican lawmakers who, could be protesting this. What's next?
I mean, as you saw in that clip earlier, the Democrats are going to make this about abortion, about Roe v. Wade. And, the Republican leadership did tell President Donald Trump that, this was reported by other publications, that Kavanaugh might be one of the more difficult ones to get confirmed just because he has been a judge for so long and he has ruled on so many important cases. That's probably going to mean a lengthy process. But in terms of sort of tech's response to this and where they stand, I mean, the big tech companies haven't said anything. They have, the lobbyists for startups and for the big tech companies are kind of holding their tongue today. And if you're Amazon, if you're Facebook, if you're Google, you're a big, massive corporation. Maybe you want someone like Judge Kavanaugh on the court who will have a sort of pro-business or pro-corporation interpretation on laws that come before him.
Bloomberg's Garrett DeVink there. And if you are planning to be out in the sun, you will need some SPF, and it's no different for NASA's newest probe that is getting the best solar protection possible. NASA's Parker Solar Probe has been given an ultra heat shield to keep it from burning up, as it will attempt to get closer to the sun than any vehicle before it. Temperatures on the shield will reach nearly 2,500 degrees Fahrenheit as Parker approaches 4 million miles from the sun's fiery surface. The shield will help keep the probe cool at 85 degrees. NASA engineers installed the protective shield in late June ahead of an August launch. They are hoping to make new discoveries about how heat from the sun affects life on Earth. That does it for this edition of the Best of Bloomberg Technology. We will bring you all the latest in tech throughout the week. And this week, we will have full coverage of Amazon Prime Day. We will be speaking with an Amazon exec straight from Seattle. Tune in each day, 5 p.m. in New York, 2 p.m. in San Francisco. And Bloomberg Tech is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network, TikTok, on Twitter. This is Bloomberg.